Okay, folks, you have to forgive me for my crude artwork here. This is the result of my MS Paint skills. So if we're looking at these crude diagrams here, I want to ask you a simple question. Look at these two groups of bars, okay, and they're going to basically take uh, the place of candlesticks in a price chart, okay, and this is universal on all time frames, but it's better to see it on like a daily or 4-hour. It can be seen on an hourly chart, but anything less than an hour chart, I don't really have that much faith in. But if we see it on daily 4-hour, it is, in my opinion, of significance. And I want you to take a look at it and tell me if you see anything that stands out. At first glance, it looks relatively the same. Doesn't seem like there's much in way of any distinction until you look at it a little closer and you realize that this first group over here has a candle going slightly higher than this one in here. This candle here, okay, this is the extreme or the stop run or to engineer liquidity, pushing away and causing buyers to buy up here towards the high. Again, over here. The way we look for professional distribution at price highs is we want to look at the candles around the high, not just the high itself, okay, because everyone understands that these SMT divergence that I use and taught, it's pretty powerful, pretty strong, but it relies on comparing specific highs against old lows of another closely correlated asset. When you're looking at price action, what you're doing is you're going to look for clustering. Okay, so this is what this is. This is a concept called clustering. And what we do is we look at the group of candles around the high. Whatever high forms that we anticipate being resistance, or if we think that the move is near the end, we want to note that and then all the candles around it. Okay, now how many candles? Like 30 of them? No. About 4 or 5, this is about right. And what we're doing is it can go 3 candles back to the left or 3 candles to the right. I think it's a fair assumption, so it's about 7 candles total. And the reason why I say that is because we could see a broadening, okay, and not just a one candle high with a lower high and a lower high to the right of it. In other words, a standard swing high. They don't always form like that. So when we have price action creating these areas like this near highs, and this is a reverse scene for lows as well, but this teaching is for distribution. Excuse me. So if we look at the high here, look at the relationship of these candles. What's going on there? We have a high, the high, higher high, low, higher high. Now this one here has a high, higher high, lower high but higher than this one, lower high, and this one fails to get back above here. If you were to guess which one would indicate weakness, which one would you say? The one on the left or the one on the right? For weakness, it would be the one on the right. The reason why, the candle right before the high here, and it could be other candles prior to it, but we're seeing this one fail to go higher, even disregarding this high candle. You can see that this is showing a willingness to go higher. This one's not showing the willingness to go higher. So this one's actually having underlying weakness. Okay, so when we look at candles near highs and lows, and especially as this teaching is for professional accumulation and distribution ideas, when we're looking for distribution, the pattern would look like this in the element of clustering. So we use the candles in an area where we already anticipate some underlying weakness. There should be some technical reason. Say it's the premium array, say it's a strong resistance level. Everything's lined up with it having potentially ran out of steam. So we start looking at the price action to see if there's any justification in this idea by way of comparing the clustering around the high candle or whatever candle touches that specific resistance level or objective. Now, if we see these elements in price action, it's a tip-off that there are smart money distribution. In other words, the higher one here, this may be the next month out, whereas this one would be the nearby contract. This is the pattern you would expect to see in the nearby contract because most of the action is always in the nearby contract. So you're going to be comparing the relationship between the price action that's in the nearest contract to the next one out. Okay, I put them backwards just to throw you off a little bit. but you have the distribution seen in this one, and this is exactly what you would be looking for. A candle that makes a high, okay, and then it has all the candles around it failing to go higher while the next month's delivery can see higher prices. And this is all fluff. It's all extra movement that isn't substantiated by any value. Over here, you can actually see the underlying weakness and distribution because the market's unwilling to go higher, and then it trades lower as a result. So let's take a look at what this might look like in a price chart, not just a crude diagram. Okay, here we have the commodity market for Chicago Board of Trade wheat. Okay, and we're looking at the relationship to this area here. Okay, and we outlined all this during the mentorship. Nice big old move. And how do you know that there is professional distribution up in here? Okay, price moved up to a logical level. We looked at Fibonacci's and ideas that put us close to this area. And then ultimately it came all the way back down and traded lower than which we saw at the beginning of the buy move. But what caused or tipped off an area of distribution here while we would reasonably expect to see normal continuation? What would be seen here in price action that would warrant a willingness to take heavy profits or potentially look for a reversal? Well, we have our high here, and we're going to look for candles to the left of it and candles to the right of it. And we have the high, we have the candle right to the left of it has its high here, the candle right to the right of the highest most candle is seen here, and we have a lower candle, this candle here, then we have this candle here. So in relationship, right before this big move, this candle here on July 11, 2017 was able to make a higher high than that of the candle on Monday, July 3rd of 2017. Now this is the delivery contract of September. Okay, so what we're going to look at is the relationship of the next month out after September, which would be December's contract. So we would just simply change this U down here to the letter Z. Okay, and before I do it, get one more look at it here. Okay, the high here is higher than this candle to the left of the most high candle. So basically we have a upper slanting line. If we draw through these candles, okay, you're going to have to just bear with me. This is a concept you're going to have to practice and look at it and study lots of examples of it, but this is what it looks like in price. Okay, these are one of these epiphanies I had looking at price charts forever and ever and ever, years and years ago, 20 plus years ago. This is the things I was starting to see that no one talks about or draws any special attention to, but this is how you actually pick up on real distribution and real accumulation in price. So we have the candle here on the 11th of July and the candle here on the 3rd. The 11th is higher than that of the 3rd in the nearby contract. Okay, so now we're going to look at the next month out and see what happens. Okay, we have the candle here, and we have a higher high. And look what's happened here. It's slanting up just the same as the previous month, right? September's delivery contract and December is an agreement. Yes. Do we see the same thing there? Well, look closely. If you just take a look at that upsloping idea there, you would miss it entirely. But we're looking at the cluster of candles around the supposed high. So if we're anticipating weakness, what we want to start doing is look at the relationship between the delivery months of the nearby contract and the next month out. This is the December contract, and you can see that, yes, the 11th candle is higher than that of the 3rd of July. But what's going on behind the scenes in greater detail? This candle here, July 6th. July 6th candle was breached on the 11th on the nearby contract. No? That's right, it didn't. Watch. We couldn't get back above that candle. So while there was a slightly higher high here relating to two candles being the 3rd and the 11th, the 6th candle of July wasn't able to be pierced with this candle on the 11th on the nearby contract. Remember, this is September. The next month out is December. So December looked stronger here because it was able to breach above the 6th of July. But that might look like strength to the uninitiated. But if you go back and look at the nearby contract where the professionals are going to be trading, you can actually see they were in heavy distribution there. So this is the effect of clustering when we look at the candles around a specific intended or implied high. When we think that this is going to be a high, and this is the same thing when we look at candles that are forming lows, where there's a tendency or a willingness to expect a low to form, you just do the opposite we're doing here. You're going to be looking at the relationship of the highs when we're looking at distribution. You look at the candles, how they relate to one another, and you're going to be looking at the lows when you're looking for accumulation around a specific low or intended to expect some support in the price action. You want to be looking at the clustering around that because you'll be able to see distribution in price action before the actual sell-off occurs. And it's always going to be seen in the front month, the nearby contract. Usually, the distant month or next month out will always be the one that looks stronger or the most weakest. Okay, in other words, when we're looking for accumulation, the next month out will go lower. The nearby contract won't go as low. The nearby contract, when we're looking for distribution, won't go as high as the next month out does. And that way it looks like it's stronger as we look at the next month out, but it's actually underlying weakness that you can see in the nearby contract. As a result, price moves and trades lower, down more than $5,000 per contract for a contract of wheat, all based on distribution seen here.